Yes, sir. Very happy afternoon to all. So we are doing cost of capital book back question. ICI book back. We have already solved 3 questions. Totally 7 questions are there. We are moving into the 4th question. Good question, big question, but easy question. Masco Limited wishes to raise additional finance of 10 lakh. Totally they want to raise 10 lakh for meeting its investment plan. So total capital required is equal to 10 lakhs. Fine, sir. Super, sir. Fantastic. It has 2,10,000 in the form of retained earning available. Already they are having 2,10,000 in their pocket for investment purpose. Further details are as following. Debt equity mix 3:7. So this 10 lakh should be classified into two categories. Number 1, debt, and number 2, equity. They themselves said that if this is 3, this is what? 7. So 10 lakh into 3 by 10 comes to how much lakh? 3 lakh is the total debt component. And 10 lakh into 7 by 10, 7 lakhs will be the total equity component. In that equity, we can classify into two categories. Number 1, reserves and surplus, and equity share capital. Reserves and surplus already given in the question as 2,10,000. So out of how much lakh? 7 lakh. My dear lovable students, if 2,10,000 is reserves and surplus, so 7 lakh minus 2,10,000 comes to 4,90,000 will be the equity component. Super, sir. Cost of debt up to 1,80,000 and beyond 1,80,000. So this 3 lakh should be classified into two categories. This is how it is moving. Up to 1,80,000 and balance 1,20,000, because totally it should be 3 lakhs. Super, sir. If that is the case for this component, my dear lovable students, KD is equal to up to 1,80,000, 10% before tax. That is 10%, and this is BT before tax. And beyond 1,20,000, sir, 16% before tax. So KD is equal to 16% before tax. So basically they are applying traditional method, traditional approach. When you inject more and more debt into the capital structure, KD will not be constant as per NI approach. KD will not be constant as per NOI approach. Even KD will also change as per traditional approach. That's why when you are injecting more debt into the capital structure, KD is changing, KD's nature is changing. Fantastic to the course, sir. Okay, fine. Earnings per share is 4 rupees. That is the EPS. Dividend payout ratio will be 50% of earnings. So 4 into 50% will be 2 rupees will be the DPS. Expected growth rate, so G is equal to 10%. Current market price, that is MPS 0 is equal to 44, and tax rate is 50%. It will be useful for the debt KD. You are required to determine the pattern for raising the additional finance. This is the pattern for raising the additional finance. There is total capital required is equal to 10 lakh. Out of that 10 lakh, debt and equity will be there. Debt will be 3 and equity will be 7. So 3 lakh will be the debt and 7 lakh will be the equity. In that 3 lakh, up to 1.8 lakhs and balance 1,20,000. For 1.8 lakhs, KD will be 10% before tax, and balance 1,20,000, KD will be 16% before tax. For this 7 lakh, reserves and surplus will be 2,10,000 already given in the question. The balance 4,90,000 will be equity share capital. So we will be checking the pattern for raising the additional finance. Equity will be 70% of 10 lakhs, comes to how much lakh? 7 lakh. Debt will be 30% of 10 lakhs, that comes to 3 lakhs. The capital structure after raising additional finance will be equity share capital 4,90,000. Retained earning already given in the question as 2,10,000. Debt, 2 layers of debt are there. Interest at 10% per annum, 1,80,000. Interest at 16% per annum, which is totally 3 lakh minus 1,80,000, 1,20,000. So the total fund will be 10 lakh. We have done with the first part of the answer. Determine the pattern for raising the additional finance. Done. Determine the post-tax average cost of additional debt. They want KD. They want KD. You tell me, we all know that KD is equal to I into 1 minus T divided by NP into 100. Right, sir? But two KDs are there here basically. So, sir, debt actually classified into how many category? Two category. One layer is up to 1,80,000. Right, sir? 1,80,000. And another is, sir, beyond more than 1,80,000 up to how much lakh? 3 lakh, which is nothing but 1,20,000. For this, you are supposed to pay how much percent KD? 10% KD, but that is before tax. And here also, you are supposed to pay 16%, that is also before tax. So, 1,80,000 into 10% comes to 18,000 rupees is what the interest you will pay. Plus 1,20,000 into 16% comes to 19,200 will be the interest you will pay. So 18,000 plus 19,200 comes to 37,200 will be the total interest you will pay. That I can take as here I 37,200. Shall I proceed? Into 1 minus 0.5 because they themselves given as tax rate is 50%. What is the net proceeds? NP. NP net proceeds is 3 lakh because which is nothing but 1,80,000 rupees of the first part of the debt and 1,20,000 rupees balance part of the debt. Right, sir? So basically 37,200 into 50% come to 18,600 divided by 3 lakh into 100. Divided by 3 lakh into 100 means KD is equal to 6.2% is the KD. That's what the second requirement. Determine the post-tax. Always KD will be post-tax. Average cost of additional debt. That's what B part. Determination of post-tax average cost of additional debt. KD is equal to I into 1 minus T. Where I is the interest rate, T is the corporate tax rate on 1,80,000, basically 10 into 1 minus T, 5% or 0.05. On 1,20,000, 16% or 8% after tax, right, sir? So average cost of debt will be 1,80,000 rupees. You are supposed to pay 5% interest after tax, and 1,20,000 rupees 8% after tax. But what we have done is, sir, 1,80,000 we have taken 10% and we have reduced 50% tax. Both are same only. Or 1,20,000 rupees we have taken 16%, we have reduced 50%, but they have taken only after tax of 8%. So basically 1,80,000 into 5%, you will be getting 9,000 plus 1,20,000 into 8%, you will be getting 9,600. So 9,000 plus 9,600 comes to again 18,600. The same only we also got here when we done the sum, 18,600. Numerator remain the same. What they have done is they have calculated the after tax interest rate, but we have calculated the full interest. From that we have removed the tax component. Divided by total 3 lakh into 100 comes to 6.2%. Even we also got 6.2%. Comfortable, sir? That's it. The second part of the question also comes to an end. Determine the cost of retained earnings, which is KR and KE. Super, sir. So we are going to calculate the third part of the question, which is KR and KE. Sir, basically KE is equal to DPS 1 divided by MPS 0 plus G. Basically DPS 1 is equal to DPS 0 into 1 plus G. Right, sir? Sir, DPS 0 is equal to EPS into dividend payout ratio. They themselves given as what is the EPS, man? 4 rupees as the EPS, and the dividend payout ratio is 50%. So 4 into 50% comes to 2 per share is the DPS 0. That means I'm just substituting the figures. DPS 1, so I will be calculating DPS 1 also. DPS 1 is equal to 2 into, what's the growth rate given? 10%. So 1.1 comes to 2 into 110% comes to 2.2 will be the DPS 1. So 2.2 divided by what is the current market price of an equity share? 44. 44 plus what is the growth rate they want? 10 percentage. So 2.2 divided by 44 means 5 plus 10 comes to 15 percentage is the KE is equal to KR. Are you all really with me? KE is equal to KR. Are you all really with me? Yes, sir. Because in this question, they have not mentioned about the flotation cost. If no flotation cost, we all studied that KR is equal to, so is equal to 15 percentage. We will check the answer for third part. Determination of cost of retained earnings, that is KR, and cost of equity, that is KE, by applying dividend growth model. KE or KR is equal to DPS 1 divided by MPS 0 plus G, where DPS 0 means dividend paid 50% of EPS. 50 into 4 comes to 2 rupees. G is equal to growth rate 10 percentage. MPS 0 current market price is equal to 44. So 2.2 is the DPS 1. Current market price already given in the question as 44 plus growth rate of 10% comes to 15 percentage is the KE is equal to KR. Very comfortable. What they want next? Compute the overall weighted average after tax cost of additional finance. Basically, we have to just put the WACC table. The WACC table, the first one, we have to put the number. Second one, we have to put the source. Third one, we have to put the proportion, amount. First we have to put the amount, then we have to put the proportion. Why we are putting the proportion? Because we are calculating the weighted average cost of capital, then individual cost of capital and the WACC. Super sir, fantastic sir. Number 1, 2, 3. 3 sources are there. We are having equity share capital, we are having reserves and surplus, and we are having debt. In that debt, 2 debts are there, but we have combined 2 debt and we have calculated 1 KD. If you are keeping it as 2 KD, then you have to calculate 2 debts, debt 1 and debt 2. Fine sir. What is the amount of equity share capital? 4,90,000. What is the amount of reserves and surplus? 1 lakh. What is the amount of 2,10,000 which is already given in the question? And debt is 3 lakh because debt equity ratio is 3:7. Totally 10 lakh. Am I right sir? Then proportion man, 49 percentage, 21 percentage and 30 percentage. Total comes to 100 percentage because total is 100. So individual cost of capital KE, just now we find out the KE. We find out the KE as 15 percentage. Right sir? Sir, KR is equal to again 15 percentage. Right sir? If you want, if you can combine these two, and instead of 4,90,000, 2,10,000 you are separately writing, you can write 7 lakh total also, because KE is equal to KR. Like that also you can present, but better to present like this because the answer will be big. More mark you may get. Sir, KD is equal to, just now you find out KD as 6.2 percentage. Right sir? So 15 into 49 percentage comes to 7.35. 15 into 21 percentage comes to 3.15, and 6.2 into 30 percentage comes to 1.86. So KO, weighted average cost of capital, is 7.35 plus 3.15 plus 1.86 comes to 12.36 percentage is the overall cost of capital. That's what 12.36 percentage is the overall cost of capital. Computation of overall weighted average tax cost of capital, equity including retained earning, as I already told. If you want, you can show it as one item also, because nothing man, KR is equal to KE. If in question flotation cost is there, KR will not be equal to KE. At that time you have to bifurcate and you have to show. So debt is there, totally 10 lakh. So KO is equal to 12.36 percentage. So I hope that you are able to get the book back question. You are able to understand the question. My dear lovable students, you know one thing. Out of our 7 question, we have solved 4 question. What I want from your side is, you try question number 5 before you listen to my video. Go wrong or get the right answer. And if you are listening, you will be getting a different perception for the FM and costing. If that is the case, you will be feeling so much confident. And the next question is a little big question, question number 5. I am waiting for you to try and I will be checking. So with this we can say that we have done with question number 4. 4 by 7 is the target.